gold is going much, much higher.
Yep.
I have a target of $35,000 or something like that going into early 2030s. And I think we're going to go there. But what I'm saying is that does not rule out a 40% decline into a deflationary bust where the Dixie can go to 122. It does not.
30% dip in the next market crisis. I'm relatively using that as a buying opportunity, but smugly for
but
those.
Hold on, you have the notion that we'd have a 40% drop in gold. What do you think?
I don't think we will. I agree.
If the treasury market is doing and the dollar is doing what Henrik is saying, and you're having a 40% drop in gold, if you even just get to a 20% or a 15%, what do you think China and Russia are doing with any dollars or treasuries they hold? It's amazing. Thank you for the liquidity. Have it all back.
Henrik Zeberg, Francis Hunt, and Matthew Piepenburg sit down for a heated roundtable, clashing over the trajectory of gold. Zeberg warns of a looming deflationary bust, predicting a sharp 40% drawdown in gold before a parabolic surge to $35,000 an ounce. His logic is straightforward. When markets seize, investors liquidate what they can, not what they prefer. He points back to 2008, when hedge funds dumped gold to raise cash, as the model for what comes next. In his view, debt-heavy players, or even entire nations, could be forced into the same behavior again. In that crisis moment, gold serves as liquidity rather than refuge. Hunt immediately pushes back, calling Zeberg's stance reckless. He insists that the present climate bears no resemblance to 2008. Instead of a standard credit crunch, he sees a hyper-stagflationary collapse already underway. In that environment, gold is not expendable. It is the only safe haven left. Crucially, he stresses that central banks are now the largest buyers in the market. China, Russia, Switzerland, and others are stacking relentlessly. Hunt argues that if gold falls even 15 to 20%, sovereign buyers will pounce, offloading treasuries to secure bullion. For him, the prospect of a 40% collapse is not only unlikely but nearly impossible. Piepenburg strikes a balance between the two. He agrees the risk of forced selling exists, but stresses that debt and currency debasement are already irreversible. From his perspective, the real bubble is not in gold but in sovereign debt and fiat money itself, a system now stretched beyond repair. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Specifically on the dollar, the rates are one of the highest outside of the UK in a tier 1 nation, and they're the most indebted. And with the debt debasement is the fiat debasement to the highest order. We said the dollar will be weak. I said that, and actually with this crash, you are now 11% down on the dollar against other weak currencies. The ruble is 42% up against the dollar. The Hungarian forint and the Czech krona are 15% up against the US dollar. These are Eastern European nations. They also have minor debt issues, but not to the scale. The hegemon falls off a 26-foot ladder. It's always like that. Ask the British Empire. And that was a friendly handover to America. This one isn't. Everyone else is standing on a 3-foot ladder. This is going to be very dangerous, and you may not get your...
No, I think you make it... Look, and I tend to agree with you, Francis, but we have to give Henrik his due because... and we have to give Brent Johnson and Jim Rickards their due, too. It's not... I think what we can all agree, though, before we can get lost in the DXY debate. It's so complex. I mean, I had the debate with Brent Johnson 3 years ago. For those 3 years, I get the pride of saying I won, but the game isn't over yet. It could still change. And I think what Henrik is saying is valid. For me, again, I'm still agnostic because I started buying gold 20 years ago. If we have a 30% dip in the next market crisis, I'm relatively using that as a buying opportunity. But smugly, for those...
hold on, you have the notion that we'd have a 40% drop in gold. What do you think?
I don't think we will. I don't think we will. But we have to... What's that?
What is China? The gold is running not because of you and I. It's running because of central bankers.
That's my view too, Francis. I agree.
If the treasury market is doing and the dollar is doing what Henrik is saying, and you're having a 40% drop in gold, if you even just get to a 20% or a 15%, what do you think China and Russia are doing with any dollars or treasuries they hold? That's amazing. Thank you for the liquidity. Have it all back. These guys, China is a patience trader. They are not a trader. They're a patience investor. They sleep on the riverbank and wait for the dead bodies of their enemies to come by. That's
why I think it's ultimately...
That will absolutely unload everything into wherever the sudden liquidity is coming from. So how do you get a 40% collapse with all the major central banks, probably including Switzerland, which is supposed to be a friend, but was also been accumulating gold? Every major central bank, which is the key move the needle gold buyer, on a 40% drop. So we're at 3,300. You're talking 1,700, 1,800. Great. They're going to load up and they're going to get rid of all those treasuries. They'll be doing it long before you get that 40%. And I
don't think it tops yet. I think it has a little more higher move than before we top, but I think the top is in around 3,700 or something like that. And then I think you're going to see with the Dixie spiking up like that, you're going to see a very large decline. And again, into a deflationary bust like what we could see here, everything is overvalued. We agree on that. Everything is overvalued.
Who's selling the gold and who's buying the treasuries?
But it's not. It will be about. Trader? Because you'll also have a situation potentially where there will be, you had a situation also where gold actually dropped because there was at least the rumors said there was a hedge fund, in problems and they had to go sell gold and you saw a large decline in that gold. I can't remember when it was. It was not so long ago. So things can happen. If the floor opens up and a lot of people are starting to lose their money on their crazy crypto investments or whatever it's going to be, or their hedged long
that's retail.
Leveraged.
That's not central.
No. But
this is good. This is
exactly.
good. This is good because it's important to have a disagreement on the DXY. We agree on gold.
What we're actually saying is crypto kiddies that are losing money on crypto, who happen to be big gold holders, are now going to be selling their gold, and they're going to crash the gold market in an environment where it can also be sovereign state.
It can also be sovereign nations that can be in problem. It can get a problem if you start to see that they're the yield levels are specking off.
But Henrik, are you saying that in this event where the Dixie spikes in this short-term window of shit happens, excuse my French, is that going to be driven more by a need to sell gold for liquidity, or driven more by a need to buy U.S. treasuries as U.S. dollars for safety in that moment?
I don't think there's either or. I think there'll be a plethora of things. I think it'll be driven by the need for liquidity, and the only real liquidity is where the debt is denominated in, and that will be denominated in dollars. You can't pay off your debt with gold. You need to sell gold. And the thing with gold is that it's fantastic to give you liquidity when you need it, and that's what it's there for. So you'll probably see that the sell-off will be something
what happened in 2008. I'm just trying to find
arguably, which is the 35% decline.
Unlike 2008, I'm just trying to. I'm not saying this isn't a foolish argument.
No, that's fine. We just
unlike
discussing.
2008 though. Today in 2025, the mood, the need, and the status of gold, not just in the headlines, but literally at the BIS, literally at the Fed, even all this nonsense and discussion about gold-backed U.S. dollar again, and not to mention revaluation, not even going down those rabbit holes. What we're seeing with the use of BRICS gold as a trade settlement for net settling, what we're seeing in the oil trade, what we're seeing with the stacking of physical gold in the East, don't you think the environment from the BIS to the Shanghai Exchange to the SPYMEX in St. Petersburg is so different now than in 08? Maybe you could argue that's even more reason to dump the best asset in an moment.
I'm not sure. I mean, I'm not sure. What is not different here is that you have a bubble that has a size that we don't even know. We don't know the fallout of this. If this is going to happen, as I see it,
we don't know the size of the carry trade. Why aren't we talking about a yen spike?
But even before we look at the carry trade, look at the U.S. Treasury today versus 2008. Again, if you're using 2008, which I think is a valid comparison, but the U.S. Treasury is so less loved, so less trusted, and so much further in debt today than it was in 2008. That it is no longer the safe haven that it could have possibly been in an 08 liquidity need, where gold could be. But I'm still saying, I guess I'm saying the real issue is...
Peter, Matthew, was 4.3% during the carry trade crisis last year. That's how much it lost. Bitcoin lost 30%. This is not a very low downside beta at the moment. The buyers and the money shows up. The buyers and the money shows up because the rest of the world outside of America is already planning for a held gold, at least backed in some way, even not implicitly stated by who holds the biggest gold. And we all suspect it's China, which is deceiving the 2,500 ton number, which is probably more like a 50 going on 100,000.
And poor Henrik, you're on the block here, Henrik, and I'm not saying you're wrong. I think this is good. You've got the cojones to take a stance here, but to Francis,
I'll bet you a dinner in South Africa.
Okay, if in your model, how much gold does China really have? And it's not what the World Gold Council has.
But
so in that,
I think you're making fundamental and rational talks about why it would go up. Am I disagreeing with that? No, I'm not.
Right.
But do I think we can have a liquidity situation where things can be sold off? Yes, I do. And if I look to the price of silver and I look to the price of platinum and so on, it's nowhere near where gold is.
You're
So the whole thing.
market being bid up.
One second.
Francis, let Henrik finish.
One second. Yeah. So the situation is also that everybody has been front running his whole narrative that you're now talking about. And silver and platinum and the gold miners, somebody forgot to send them the memo, by the way. So I think you're talking the narrative of gold, and that's why I'm saying gold is in and now I put it, a mini bubble.
Right.
Because everybody has talked the narrative up at this point. I agree with you.
But see,
it will change. It will change down the road, but you're going to see that oh shit moment where liquidity will become everything.
And you could be
and
right,
that is
Henrik,
where you need
what
it.
if gold is not in a bubble at all? What if gold is simply doing what gold does best, and the only thing that's in a bubble is the US dollar or the yuan or the yen?
Somebody should have told platinum, silver, and GDX.
I think the GDX, I think platinum, platinum's another conversation. I think silver always is the little speedboat that can once gold hits a bull market, but gold isn't in a bull market yet. That's why silver hasn't taken off.
But I think silver actually looks even worse than that. If you look,
it's amazing to me that we're talking about a gold bubble and not a debt bubble.
Francis Hunt stresses that central banks are now the heaviest buyers of gold, while the U.S. Treasury market faces growing distrust and global debt levels sit at extremes. In his view, if gold were to dip even modestly, central banks would immediately step in, offloading treasuries to accumulate bullion. That dynamic makes it hard to argue gold is overvalued, especially since it has yet to reach its CPI-adjusted 1980 high, despite debt loads being exponentially larger today. For Hunt, the long-term case has never looked stronger, with price targets in the tens of thousands by the 2030s. The real debate is not whether gold rises, but how it gets there. Henrik Zeberg argues that a brutal sell-off could come first if liquidity vanishes, forcing investors to sell gold just to raise cash. Hunt rejects that, warning that those waiting for a mythical 40% dip may miss the main ride entirely. A debt crash, he says, is a fiat crash, and gold remains the anti-fiat trade. Even Zeberg, however, does not dismiss gold. He sees it as an essential holding, though he envisions a better entry point if a dollar spike triggers a temporary shakeout. Both sides agree the destination is higher, but the road diverges. One camp braces for pain before liftoff, while the other insists the liftoff has already begun. What unites them is recognition that gold is no longer just a hedge. In a world drowning in debt and distrust of paper assets, it is fast becoming the centerpiece of survival. Let's get back to the interview.
You're basically saying gold is kind of itself in a bull market, maybe a little bit inflated, hype, front running, and that the real, and I'm simplifying that, when there's a real moment, that there'll be an 08-like sell-off because 2025 is very similar to 08. I would argue it's different. But if you were to change your thesis, it's a little bit, if you could think of, and maybe you don't, that it's not that gold is in any kind of a bull market. If anything, gold is doing what it always does, which is nothing. It just sits there. Well, fiat money is very busy, and sovereign debt is very busy debasing fiat money. And what we have is a major, I think, fiat bear market, and a bull market for gold is simply waiting for the fiat to die.
That we agree on.
But you don't think there's a difference in degree? You still think the gold is overvalued given the level of U.S. or global debt? You still think it's overvalued?
No, I think, as I said also, I think gold is going much, much higher. Yep. I have a target of $35,000 or something like that going into early 2030s. And I think we're going to go there. I just want to say, like when I'm talking to Bitcoin guys also, I'm saying, you know, guys, I know the saying of institutional adaptation and all these things, you know, but by the end of the day, I think it's a bubble. Okay. And I think that's the way it is. What I see with gold is that I think gold has a fundamental and it's going to also, if I look at Bitcoin gold actually ratio, you can also see that there is something to that. Bitcoin was outperforming a little more, and then you're going to see gold actually taking over again. If you look to the SPX versus gold, you can also see that we have a similar situation like what we had in 1929, in 2000, and in 2000 actually, and also 1971. Sorry, also with Nixon. So we have a unique situation here where yes, gold is going to outperform in the longer time frame. That is if you take the dollar out of the equation. But that's not what you can do in a deflationary bust, because that is when the dollar is everything. The dollar is everything, because you need to pay your debt. So if I get it right,
when you say the dollar is everything, you're saying the debt instrument is everything too. You've got to talk about both. Who's buying the debt?
Yeah, but
this is a
again,
gold bubble, apparently, according to you, at the moment. How can you? I don't see how technically you can say that. We haven't even reached 2000, the 1980s
no. I'm not.
high.
I'm not.
This
First
is
of all, I'm not.
adjusted for the fake statistics that you like, the BLS. These are their stats, dividing by the CPI, and that's where you are. You haven't even met the CPI adjusted high of 1980, and we are in 130% of debt in the United States, 39 trillion, where we were compared to in 1980.
But these are fundamental things I don't disagree with. I don't disagree with that. And as I just said, $35,000 per ounce. I mean, that's the highest numbers we have heard on gold today, right? That's my target. But what I'm saying is that does not rule out a 40% decline into a deflationary bust where the Dixie can go to 122. It does not.
And what will lead that Dixie to 120? Because there will be such a need to get liquidity to pay off dollar-denominated debt. Is that simplifying?
Everything.
As opposed to maybe just defaulting on that debt or selling treasuries.
But still, you have to settle that debt somehow, right? It needs you need to settle that debt somehow, and it's not just a simple thing. If it's, it's a housing bubble, it's a crypto bubble, it's a tech bubble. There's so many things that are going to blow up, and I think that
is gold a bubble or just the best asset in an moment.
Of course, it's going to be a fantastic asset at some point, but there are different phases for things. And what I'm saying is a deflationary phase where liquidity will be everything to pay off things. I don't think gold is the best. It's the best time for gold.
No one's going to buy.
Would I buy it? Would I buy when it comes? If it's answered, yes, I'd rather buy it on the sentiment where people are saying, "Oh, I don't want gold,"
right?
Because it's just and I don't think that's the sentiment we have right now.
You can't get rate cuts without some aggressive buying of the bond market. Who's going to rush in and buy all the US issued bonds in an aggressive way that it pushes prices up immensely, sufficiently for you to have that dip in rates that's going to lead to a 40% correction in gold?
We've seen who will go out and buy this in previous times. That's still there. As I said, also, I don't think you're going to see a new all-time low on yields, but I think you'll still see that people also will run to the dollars and to the U.S.
But if you're wrong on that,
there's a lot of reasons I think this is a dangerous discussion. I think it shakes people out of the core holding that should be an investment, not a trade. On top of the fact that there may be a dollar spike, we don't know how deep the yen carry trade. It could be the yen that spikes when America has to repay back all the loans. You don't know the underpinnings. There's going to be many turns. We can play guessing games on all of this. First, for you to get a major collapse, such as 40% on gold, on the basis of everybody suddenly needs dollar means, and rates collapses means everybody's rushing into treasuries. You can't mention the dollar without mentioning treasuries. If you think the dollar is going to get strong, you need money that isn't already in America to be flooding into America and buying treasuries. Why can't they buy other debts? The German debt is cheaper. It seems it's priced as less likely to die. I'm not recommending any debt, actually. The position is gold. Stay with the position. You're in a debt-based crash, and the hegemon is the most indebted of them all. It's not the cleanest shirt at all. You can see from its rates in tier world nations that outside of the UK that's just jumped ahead of it, it's the one that's going to collapse. It falls hardest when you're a hegemon. These are the summary points that I want to get out. The dollar will crash with the debt crashing, no matter what little engineered volatility comes along. Position for the main journey and make sure you make the main ride. The move will make you your wealth. Try get too smart, you're going to miss this. You're going to get caught out on unobtainium. You're going to get caught out trying to buy on a 40% dip that never comes. All sorts of things can occur. Debt-based crash is a fiat-based crash. It's really that simple. The anti-fiat trade is gold. You buy gold, you are actually anti all fiats, and particularly the hegemon fiat. That's the dollar. That's the key thing.
Now obviously, I've got to support Francis, not because I'm selling my book or my bias, but I do agree with Francis. That doesn't mean that Henrik isn't. I don't think he's trying to sell a foolish narrative. I think for any of us in the long or short-term gold trade or investment, we have to look seriously at these arguments, not as tricks to sucker people out of the gold market, because I think Henrik totally understands the gold market and believes it's a strong investment. He just sees a potential better value play post a Dixie boost, and I think he's not alone in this argument. I can't just be a fiduciary in the gold space and say gold will never have a serious retracement, that it's impossible, that there couldn't be a scenario that Henrik has put forward that's plausible. It is plausible. I do tend to agree that you can't look at the U.S. dollar without looking at the U.S. Treasury. I don't see it very similarly. I would agree that there could be a major sell-off in gold to get liquidity in an moment in the risk asset space. The degree of how serious that could be is up for debate. I don't think you're wrong to suggest it could be significant. I don't think you're wrong. I think Francis believes wholeheartedly that you're wrong, and he's got a passion for it. That's what makes a good debate, and I think he's a bright guy.
Yeah. That's fine. That's absolutely.
I think I'm sorry I missed 80% of it dealing with Elon Musk satellites, but I think I really wish I could.
All good.
But I think for us, whether it's a near or long-term play, it's absolutely essential to own gold. I think you make a strong case of, well, look for your buying window.
What emerges from this clash of outlooks is not a settled forecast, but a picture of how fragile the system has become. Whether the next chapter brings a short, violent squeeze or an uninterrupted climb, the underlying story remains the same. Trust in government paper is wearing thin, and the world's most powerful buyers are already repositioning. Gold is no longer a side note in financial strategy. It is moving closer to the center of the stage, shaping decisions at every level from households to sovereign treasuries. Will the turning point come through a sudden crisis that jolts markets into liquidation, or through a slower unraveling that drives capital away from paper promises and into hard money? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.